Hi, good afternoon, everybody. Thank you so much for joining us this afternoon. Whilst we wait for a couple of other participants, I'll play a short video. Wonderful. So good afternoon. Welcome, everybody. Thank you so much for joining us on this beautiful Thursday afternoon. My name is Laura Nieves. I am proudly responsible for Astor Realty Capital's investor relations and operations. So today we are very excited to share with you our newest investment opportunity. It is a luxury condo development in Gravesend, Brooklyn, New York. We will have the opportunity for questions and answers during this Zoom. So please feel free to drop your questions into the chat below, just right down there, and we will be sure to address them either during this Zoom, and if not during this Zoom, we will reach out to you after. So firstly, as most of you are aware, but I would like to say a few words about our company, Astor Realty Capital. We're a private equity firm, and we're currently participating in over $1.7 billion of real estate in 10 major US states. We are headquartered in New York, and we have offices in Miami and Phoenix, Arizona. And along with the Astor team, we have Joe Burko and Michael Corrine, who are co-founders of Astor Realty Capital. And we are also affiliated with our sister company, Burko and Associates. So on that note, I am proud to pass you over to our host today, Joe Burko. Joe is one of the co-founders of Astor Realty Capital. Over to you, Joe.
Thank you very much, Laura. Good to see so many of you. Happy New Year. Happy to start the new year with a bang, and hopefully you'll see what we do in this next transaction. The backstory of it is that it's a fantastic deal that we've been chasing, and we've signed up into soft contract right before the pandemic. The pandemic hit, and then we decided to abort the project, but now we're with full confidence back on it. So to dive right into it, this is an asset that's located in Gravesend, Brooklyn. It's a very unique, I would say, a little small little bubble, and we'll talk more about why I consider it this way. But the asset is located on 346th Avenue U in Brooklyn. It's going to be brand new construction. boutique luxury condominiums. We're going to build and deliver 16 condo units, family size units, just shy of 2,000 square feet on average. We're only building about 33,000 square feet and delivering 27,550 net rentable sellable square feet. Total budget is 29.45. We're going to be utilizing $22 million of first position debt and coming into the project collectively with our developing partner at $7.425 million, out of which the developer is going to infuse 1.5 million, and we'll take the 80% chunk at 5.925 million and hold the majority ownership. We're running the project, well, this is a short project. We're analyzing it at around 36 months to 42 months. For this purposes, for this presentation, we're looking into the lengthier one. And based on that, we're analyzing a 25.32% annual return. That's to you, the investor, after payment of our asset management fees and after our promote and participation in your profits. And we'll talk again more about that. Our concept design, this is going to be a luxury boutique. This is obviously renderings. I don't want anybody to think that this has already been achieved as a design concept, but we're drawing from those type of interiors. We like the project because we feel it's a simple project in comparison to a lot of the other projects. And those of you that participated in our last investment, the legacy deal, that's almost 1 million square feet complex building that has an office component, a medical component, that has an SLS hotel, and has 310 units. This is much simpler, much smaller, and just a sexy little deal. So we're anticipating around 25% plus, and I'll talk more about the plus, and you'll see hopefully what we see about that. It is a seasoned developer. This is a family that has been in the business for well over 30 some odd years, heavy investors. This is second generation that we're working with. And we have a fantastic track record with them. We're about 2.5, 3 years into another project with them that is on time, on budget. We'll actually talk about that project a little bit as well. And I think that the story of all stories here is, I think, the location. The location is called Gravesend, which is the heart, main of the Jewish Syrian community. It's a very cliquish community, a very tight-knit community that simply has to be close to its centers of worship, next to the synagogues, next to the rabbi, and must be in walking distance. And therefore, we've created some sort of a zone that you simply have to be within in order to belong to that particular synagogue, and that causes the demand to go through the roof. It's also one of the most affluent communities in the United States. I wouldn't say the most affluent community in the United States, but it's certainly one of the most certainly up there when it comes down to it. So we have almost like a perfect storm. If you think about this, we have a phenomenal demand. This is a family-oriented neighborhood. Everybody's going to the same schools, the same yeshivas, and they simply have to be kind of like living together. In terms of timeline on this project, we've started the design planning phase. Obviously, a lot of due diligence have been done. This project, as I mentioned, we're circling for probably 1.5 years now. So we feel very confident. The individuals that we're teaming up with are from the community, of the community, and the project is for the community. So it's kind of like easy to understand the demand drivers, who's buying it, and so on. So, but the design planning phase have started already, and we're looking into 12 months. It's probably a little bit exaggerated. We're probably going to get the approved plans, certainly to go into the ground way before that. But for our presentation here, we're assuming 12 months, then 26 months of construction. Sometime around middle of that, let's say sometime around month 20, month 22, we'll start the soft marketing. Now, 16 units in an area that has almost no supply, almost no new supply, certainly not at that price point, will most likely get absorbed extremely quick. We sometimes joke around and say this is probably going to get sold in a couple of weekends, at the synagogue. So we're expecting a very, very easy marketing. And in fact, the conversation is people are already hearing about this project and are already getting interested, but way too early to go into that conversation. And then of course, occupancy. So here again, we're analyzing 42 months on this project with real true anticipation that we will be able to deliver an exit for you sometime around, I'd like to say maybe between month 24 and month 32. And what does it mean, you might ask? It means that your IRR or return on investment on an annualized basis will probably go even higher. Looking at the capital stack, as I said before, we're taking just shy of 75% first position mortgage, $22 million. Astor Realty Capital and its partners from Israel. We are institutionally backed. For those who are not familiar with our operation, we bring the majority of our capital from one partnership. That's a great partnership that's been going on for the last 5 years. And then we always allocate a certain amount of dollars for our friend and family that's been, thank God, it's been growing and it's been doing really beautiful. So collectively, we're coming with $5.9 million. Astor is the custodian of that capital. We always want to see that our developing partners are coming with real money to the table. Our requirement is 20%. So we have that balance here, what we call skin in the game. Our developer is coming with 20%. So the total sources that we're going to be used for this project is $29.4 million. In terms of sources, in terms of uses, you have the full breakdown here that talks into the various parts, such as our concentration of hard costs, soft costs, contingencies, acquisition fees. Everything is detailed. In this presentation, we obviously don't go deeper than high-level points, but when you'll get the presentations for those who are interested, we have all the breakdown of how we've calculated and achieved those costs. Looking at, or maybe pointing into the hard cost conversation, if you look at that line, the net square feet on dollar per square feet on a hard cost basis, 467 is a high number. It's a healthy number, the kind of number we expect when we're building very high end. We're also taking a good amount of contingency here and a good amount of soft cost to make sure that the design implements exactly the type of product that the community is seeking. In terms of our expected sales, so as I mentioned earlier, we're building 33,000 square feet, but we're delivering net sellable square feet after deducting common areas. We're delivering 27,550 square feet, assuming a $1,550 per square foot at a price point on average of $2.66 million. We'll expect to generate $42.6 million in total sales. After taking out sales costs for brokers and so on, paying back the $22 million loan, we're left with about $18.5 million in gross proceeds, returning then the equity to our investors, to ourselves, to our partners. We're left with an $11.1 million in projected deal profits. We have allocated $1,250,000 to this particular group, which is a very important group for us. It's where we place our own capital into every deal. It's where folks that have been with us, that know us since childhood, or our family members or parents, friends and friends of friends and so on, are investing with us. So it's really important for us that we have a certain amount of allocation that is left aside for that. Our minimum investment in this particular deal is $50,000. We have an asset management that each investor participates in. It's 5%, so $50,000 of investment plus your 5%, it's $52,500. This example, however, describes $100,000 investments. We do allow investors to participate in multiple points, in multiple investment units. And so we're looking at $100,000 for this example, plus a $5,000 investor participation fee, which we use to run the project going forward. There's other fees that we collect from the project itself, not from our investors. On a 42-month timeline, an investor is expected to generate $93,000. So a total of $193,000. That's include collection back of your investment, initial investment of capital plus $93,000. That will generate for us on a 42-month time span, 25.32% projected, and a total return of 88.64%. over this project. So here's another representation, a little bit more broken down. So $1,250,000 invested. We're expecting to generate $1,435,000. This is for the friends and family conversation here. Those of you that are familiar with the structure, what we do is we make sure that our investors are generating a minimum hurdle, call it the preferred return. So on an annualized basis, your investment will generate for you a minimum of 8% return before we'll start participating with you with some of your profits. So pulling aside the amount of the preferred, it will be $1,435,000 minus $350,000, the preferred. And so we'll be left with the promotable amount, where Astor participates in the promotable amount. Once we'll move away our profits that goes to Astor, which is $271,000. The investors as a collective will be getting the return of $1,250,000 profit with $1,163,000 coming back. So that will be the top profit distribution, and this is how we'll generate those type of returns as a projected. On the right side, we're doing a little bit of a stress test. The conversation behind the stress test is markets move. Sometimes markets get cooler, sometimes they get hotter, and so markets move. So we're somewhere around the middle, and I'll explain why this is the middle, but we're also looking to see if the market drops by a certain amount of percentages, 10%, 15%, what sort of minimum hurdle, what sort of returns our investors are going to be making.
Partners, as Joe mentioned, this is the second transaction that we have executed with this company, with this developer, gentleman by Lee Cohen. Laura, I'm not sure what I can do about the echo. Okay. The company's been around. It's a family business, second generation. Have been very involved in both the Brooklyn market and also to increasingly in the South Florida market. They are members, very prominent members of the Syrian Jewish community, and have very, very deep roots in this market. They know the Brooklyn market very well. And I'll talk a little bit about the existing transaction that we're in with them in Red Hook, which is a very quaint neighborhood in Brooklyn. But this is a company that really it's founded by Lee Cohen, which is the second generation. They've got a lot of experience and have a lot of success in the Brooklyn market. Laura, I'm sorry, can you please move on? So the transaction that we're currently in with Lee is 185 Conover. It is in the Red Hook neighborhood of Brooklyn, which is a very quaint cobblestone, very industrial and artistic type of neighborhood in the northern side of Brooklyn. It's an area that Lee Cohen and Red Hook Partners have been involved in a number of properties in that area. We're building a 3-story building with 21 luxury condo units. This project is going very well. We actually purchased the property in December of 2019. The building is up at this point, and we actually just were discussing the project this morning. The project's moving along extremely well, ahead of schedule, and on budget. We have not had any hiccups with regards to any supply issues. We've been very much immune in the way we've negotiated with the subcontractors from the inflationary pressures that have been hitting us. And so we're feeling very, very strongly about this project. We're already getting indications in the marketplace about pricing, which is above what we had originally projected, which was, and we're anticipating that this project is going to go very strong. The formal marketing will be launched in a couple of months, and our marketing team with Compass Real Estate are already receiving a lot of interest. So again, we feel very strongly about this project. The quality of the project speaks for itself. It's also demonstrated in other work that Red Hook Partners have produced in other projects, both in single-family homes and also in condo units. And we're looking to not only duplicate this with the new transaction that we've executed in Gravesend on Avenue U, but we're also looking to beat it because we believe that given the fact that we're building to suit for the community, there is the familiarity that Lee and his company have with what the community is looking for is very strong, and that's exactly what we're working to build. And there's a lot of trust in terms of what the community feels that he can deliver. And with that, they're very excited for this next project that's coming along. So Lee Cohen and his father Joseph Cohen have been in the business for many years. The family's been in the business for over 30 years. They've been involved in a lot of developments. They have a full staff of very strong and qualified professionals in managing the operations of the business and also in managing the project. Obviously, this is not the entire structure. There is a number of individuals that are involved on from the GC side and people that are on the ground, and it's a team that we've got a lot of faith and comfort with. These are some of the projects that they have been involved with. The second one is 185 Conover, which I described, the one that we're partnered up with. It's in construction. They have a total of $51 million in combined budgets in the projects that they've worked. These are projects that were acquired for $33 million. For a total project cost of $84 million aggregated on all the projects. And we're looking currently in marking to market these transactions, we've got about $118 million in the valuation. So there's plenty of experience over here. These are all transactions that are mostly in Brooklyn. And as I mentioned earlier, they're also now increasingly getting involved in the Miami market. The residential condo market comps are very interesting in this transaction. Gravesend as a neighborhood, as Joe mentioned earlier, does not have a strong supply of condos. Most of the residences in this neighborhood are single-family homes and large mansions. These are beautiful, beautiful properties that are owned, again, primarily by members of the Syrian Jewish community. And so there's been a very, very strong demand and virtually no supply for this type of product in this market. The only other building that is currently available is just a couple of blocks away from our property. It's the residences at 400 Avenue U. This building has been very, very popular. The resales are doing extremely well, as you can see in the table to the right, starting from the bottom and sort of like, navigating upwards. As the years have gone by, the price per square foot has been strengthening. Back a few years ago, this building was seeing, again, the demand, because the demand was so limited, the supply was so limited and the demand was much stronger. They were selling units at an average of $1,200 per square foot or even less than that. And over the past 3 or 4 years, we've seen a real increase to over $1,600 on average. And then in the past year, we've had some sales that have been much higher. The most recent sale was at $1,900 per square foot. There's actually 2 units that were sold at that level. And one of them is still actively in the market, but indications are that, we think that unit's probably going to go very quickly. I personally visited this building about a month ago. I spoke to the staff, and they were telling me that the amount of inquiries that they get on a continuous basis is just incredible. Constantly phone calls, people saying, put me on the list in case anything comes to market. And again, from what we're seeing in terms of the price per square foot, we feel that this trend is going to continue. and especially in a situation where the only other supply that's coming in the next couple of years is going to be our property. This is a little bit of a broader picture of the neighborhood. The blue circle is where we're located on Avenue U, and 400 Avenue U is just a couple of blocks away to the right. And most of what you're seeing around are either mansions and very large homes. As you can see to the left side, these are homes that have very, very high price points. And although you really can't compare it on a price per square foot to an apartment building, but it does give an indication of what there is in the area, the wealth that exists in the area, and the type of homes that people live in. And these are all individuals that many of you may have heard of in terms of people in both in the real estate business and the fashion business and other businesses in New York. And they are the ones that are really going to be driving the demand for the units in our property. So just a little bit of a perspective, and forgive me for repeating anything that Joe may have mentioned. Again, what makes Gravesend very, very special is the fact that we've got a real captive market of very strong potential buyers for this property. And given the fact that we're only looking at 16 units, you can draw your own conclusions as to the probability that these units will go very quickly. So this is a neighborhood where you've got a very tight-knit community. People are very strong in terms of being together. They all have their vacation homes and their summer homes in another area in New Jersey called Deal, New Jersey. And then, of course, they have their primary residences here. They're very prominent members of a number of different areas of the business community. They built up a lot of wealth, and they all want to live very close to their extended families. So they need to be close to a synagogue, to their shul, and also their kids all go to the same schools. So it makes this area very, very special, and also combined with the fact that most of the residences are currently single-family homes, and there are no other properties that are available for sale. When this property came up a couple of years ago, we were very strongly looking at it. We did a lot of work. We actually were putting it under contract, and for a variety of reasons, the transaction did not happen right after COVID broke out, and it's resurfaced. There's actually two lots available here. One is across the street from the other. Originally we were going to buy both lots, but we actually wanted to buy one lot first, and then wait a couple of years to buy the next lot. That was not workable for the seller. But we managed to bring in another buyer to buy the opposite block. These transactions are occurring at the same time. And so the block that's across the street from us is going to be developed into a school. So, which again is one less property that would be potentially competing with us, and also would be a school that would cater to the same population that will be buying units in our building. So, okay, so in here, as we do in every analysis for a condominium project, we always look at the rental fallback, making sure that in the event the market goes sideways and we're unable to sell the units, that we look at the demand factors, we look at where we can rent those units. And at that point, we underwrite a refinancing to see whether or not the property can be refinanced and our equity can be paid out. And fortunately, in this case, we're looking at a market where we can easily get $85 per square foot on a rental for units that would, on average, rent around $12,200. That gives us a total effective income of $2.3 million. We always apply a 5% loss factor, a vacancy factor, and we look at sort of comparable expense ratios of the operations of the building, giving us a fully stabilized net operating income projected of 1.64 million. And if we take that number and apply to it the market dynamics of calculating what loans would be using a debt yield, what's referred to as a debt yield, projecting a interest rate of 4% and a 30-year amortization, that gives us the ability to raise $23.6 million in a loan that will more than take out our equity and provide us with an adequate return. It also translates into a 4.75 cap rate. So based on all of these metrics, we believe very strongly that in the event we are unable to sell the condos, we will be able to rent the units. And again, we're only looking at 16 units and be able to refinance once the building is fully stabilized, and of course be able to take our money out and make some money on top of that.
Wonderful, Michael. Thank you so much. And on behalf of everyone here in the Miami office, we appreciate you saving the day there. We apologize for those technical difficulties, guys. We had a little bit of an outage in Miami. Michael, before we move on to wrap up the Zoom, we do have a couple of questions from our audience. If you don't mind answering, please let me know if you would like me to reference a slide to help you with your answer. But we have from one of our investors, Mark. He would like to know, as the Fed has announced plans to increase interest rates, would this affect the return on this investment?
It should not affect the return on the investment, Mark. I mean, there's always a risk that higher interest rates will create some kind of a slowdown in the market, but there's typically a lag between the timing of actually when interest rates start rising and how that affects pricing and demand in the marketplace. So within the time frame that we're looking at, I don't think that the impact is going to be severe. It's more of an impact when looking at refinancings. I think that the gap that may occur in the marketplace will the risk that it's going to affect demand and slow down the purchase market is probably going to be much less this time around. There's a lot of capital that's sitting in the sidelines, and there's a lot of very strong external elements that are affecting the real estate market. So we don't think that, at least for the foreseeable future, the effect is going to be that high. Obviously, it all depends on how quickly those interest rates rise and how much they rise. We know that the Fed is talking about a number of different, maybe up to 2 or 3 increases this year, but those really, judging from the way the market reacted a few years ago when interest rates started creeping up, there were a lot of other pressures that forced those rates to come right back down about a year and a half later. So we don't think that, specifically from a return perspective on this transaction, we don't see that it's going to affect us significantly. But there is always a risk, obviously.
Thank you so much, Michael. We also have another question. Would the current issue with labor and supply chain affect the construction timeline? And please feel free to drop other questions if you have them. Take this opportunity with Michael.
Absolutely. So yes, there's always a risk that supply issues are going to create delays in the schedule and also pricing pressures. And as we're doing currently with all the projects that we're currently involved in, we're monitoring all of that very, very closely. Obviously, we look at the budgets very closely. We monitor all the negotiations with the trade and the subcontractors when we're doing all the buyouts and finalizing those negotiations. We're currently in the process of doing that here. It is a process that takes a few months. But typically the way it works is that we enter into very detailed negotiations with each particular subcontractor that handles a particular specific trade. and we lock in the pricing. We finalize those budgets and then proceed with the projects. Now, the good thing about that is that if you have a team, and this speaks to our confidence with Lee and his company, if you have a team that is able to navigate those negotiations properly and be able to create a favorable pricing environment on the budget, then that locks us in. It's a hedge against any future increases, obviously down the road. If the markets do go haywire and prices, for example, they go up as they did last year with lumber significantly, then those are situations where the contractors may come back and look to renegotiate. So there is always a risk that there's going to be increasing pressures to the budget. We've seen that happen on a number of our projects where we did end up with some budget cost overruns because of those pressures. However, because these are negotiated up front, that does lock us into pricing and provide us with a hedge against any future inflationary pressures.
Perfect, Michael. Thank you so much. That was a great answer. And I do have one more question from one of our investors, and perhaps you can lead this into, the final slides of Astor. But what is how does the legal structure work for Astor investors, and what should I expect when working with Astor? So really, I take that question as, what are the next steps if an investor does decide to proceed with this investment opportunity?
So we ask that you obviously, you look at the package that Laura has either sent out or will be sending out. Let us know as quickly as you can your level of interest with this type of project. I can confidently tell you that I think we're probably going to be selling out the units very quickly. We will follow up with the full package. You will be provided with access to the data room with all of the due diligence material that we use in underwriting and analyzing each and every one of our transactions. Once you review those, we'll also provide you with a draft of an operating agreement that you'll be signing with us. At that point, we would ask that once you are committed to the project and you sign the operating agreement, we will then inform you about the time to transfer your funds into a special escrow account that we'll set up for this transaction. Your money will sit in escrow. Obviously, it will not be touched by anybody until the time that we close on the overall partnership, and that's the point where we will have the escrow bank transfer the funds to the title company on the other end. During this time, we will complete the negotiations on the operating agreement at the partnership level. We will provide you with a copy of the overall partnership agreement that gets attached to your operating agreement with us, and you will have a chance to review it and make sure that that the information that you see in that conform to what we're representing to you on this call and also on the marketing material that you will be receiving from us. At closing, once we sign the operating agreement with our development partner, at that point we will countersign and date the operating agreement with you, and all of that material will be provided back to you and will also be deposited in the portal that we have for investors, where you all have access to all your documents and all your account information. I hope that answers that question. I'm happy to get into that in more detail if need be.
Fantastic, Michael. Thank you so much. And thank you everybody for joining. Michael, if you would like to bring us home.
No problem, no problem. So once again, just to tell you a little bit about Astor and beyond the video and what Joe had mentioned, our primary consideration is the preservation of capital of our friends and family. It is something that we pay a lot of attention to, and it's always the main driver behind every decision that we make in investing in transactions. Part of the service that we do is ongoing asset management over the next 4 years. or 3 years into the project. As we do with our current projects, we monitor on a monthly basis, sometimes even more frequently with our development partners. We're constantly monitoring the budgets, the timelines. We are visiting the properties, traveling to the sites, making sure that we understand everything that's driving the project. And of course, on a quarterly basis, we provide you with reports so that you will have access to the same information on an updated basis throughout the life of the investment. We always strive for above market returns. We're very, very selective about the transactions that we get into. Typically, our focus has been into ground up construction of both rental and condominium properties, primarily in the multifamily sector, but also we're currently looking at transactions in other parts of the real estate business. But the reason why we go after construction deals is because we're very familiar with the process. We know the business inside and out, even though we're not builders and developers. With that, we feel that if we understand that space well enough, then we should be able to go for the higher risk transactions and comfortably represent and manage the funds of our investors. There is a real alignment of interest between us and yourselves. We treat ourselves exactly the way we treat you. I put my money, Joe puts his money in every transaction. We are members in the operating entity as much just like you are, even though we're managers, but that does not give us any other preferential treatment. So the goal that we have is very much aligned with yours, and it's in line with essentially not just protecting your capital, but also maximizing your returns. We do at a real personal approach. We're a small company. We have a few individuals that are 100% dedicated to you at all times. Laura with her investor relations, both Joe and myself are always available to get on calls, to answer questions and do whatever it takes to make sure that you have access to all the information during the life of the investment. Having said that, we're currently approaching this year a number of investments that we currently have that we're exiting, and we're very, very happy with all of those. The results are going to speak for themselves. I think all of our investors in these transactions are going to come out very happy. So we're very excited about the prospects this year. These are a sample of some of the transactions that we've been involved in. On the top left, we have our project in downtown Brooklyn, which is currently one of the hottest new buildings that is actively trading in the Brooklyn market. It's doing exceptionally well on a price per square foot basis, and is also the talk of the town when it comes in all of our conversations with brokers and agents that are involved in the Brooklyn market. They tend to bring up this deal as a strong comp for other projects that they're looking at. In addition to that, we're involved in a number of projects in Manhattan, in Queens, in other parts of New York. We've got another project in New Rochelle, which we closed on a few months ago, and we're already up to the building, the 5th out of 19 floors. And we're also involved in a number of projects down in Miami. So with that, we have about 60 years of collective experience. Laura gave you the statistics with regards to our portfolio. If you have any questions with regards to this particular transaction, please feel free to reach me or Joe or Laura, and we'll make sure that you have all the information that you need. Thank you very much for your time today. We hope you enjoyed this session, and we very much look forward to working with you.
Thank you so much, everybody. Wishing you a blessed evening. Thank you again, and we look forward to being in touch soon.
Thank you all very much.